Welcome to The Explainer. Today, we're diving into TechPrecision Corporation's fiscal year 2026 earnings. And honestly, we've uncovered a totally fascinating business strategy. We're constantly told that the ultimate goal in business is growth at all costs, right? But what happens when a company intentionally decides to shrink its revenue just to get healthier? We're about to unpack a literal masterclass in strategic contraction. Let's get right into it. Okay, so let's look at this bizarre reality. For the 12 months ending March 31st, 2026, TechPrecision saw its total revenue drop by 7%, falling to $31.6 million. Now, normally, a drop in top-line revenue causes absolute panic. But check out the other side of the equation here. Their gross profit actually went up by an impressive 15%, hitting a rock-solid $5 million. Which brings us to a massive paradox that we absolutely need to unpack today. I mean, how on earth does a heavy manufacturing company intentionally shrink its revenue footprint, produce less top-line cash, and somehow end up significantly healthier financially? It seems completely backward, but as you'll see, it's actually a highly calculated maneuver. So, to solve this mystery, here's our roadmap for the explainer. We'll start with the profitable shrinkage paradox, then do a quick run through the FY 2026 numbers. After that, we'll explain Ronor versus Stadco, dive into their strategic project mix, and finally wrap up with their skyrocketing guidance for 2027. All right, let's jump straight into section 1, the profitable shrinkage paradox. First, let's quickly translate some Wall Street jargon, because it's important here. In their earnings report, TechPrecision bragged about a 300 basis point margin expansion. When you cut through the financial speak, 100 basis points equals exactly 1%. So what they're really saying is they managed to squeeze out 3% more pure profit on every single dollar of revenue compared to the previous year. That's a massive win for absolute efficiency. Moving on to section 2, FY 2026 by the numbers. The absolutely crucial turning point here lies in their cost of revenue. Look at this. While total sales dropped by 7%, their cost to actually manufacture and deliver those goods dropped by a massive 10%, down to $26.7 million. Because their expenses literally plummeted faster than their sales, the company's net loss improved by a staggering 41%. Basically, they just stopped doing work that cost too much to execute. Now, before we look at their core operational cash flow, let's quickly define EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization. I know, it sounds super complicated, but you can essentially think of it as a scorecard for a company's day-to-day core operational profitability, stripping away all the accounting noise and financing costs. This metric is right where their turnaround strategy truly shines. And this brilliantly illustrates the proof straight from the company's own source report. Their EBITDA climbed from a rather meager $587,000 in 2025 up to over $1.64 million in 2026. That is an improvement of over $1 million. Their day-to-day operations became significantly more lucrative, even with way fewer dollars coming in the front door. Okay, let's head into section 3, Ronor versus Stadco explained. To understand where this improvement came from, we need to look at their two subsidiaries. First up is Ronor, located out in Massachusetts. Think of Ronor as this heavy-duty manufacturing powerhouse. They operate out of a massive 145,000 square foot facility, and they are capable of machining incredibly precise components that weigh up to 100 tons. It's serious heavy engineering, and over 95% of their revenue comes directly from the U.S. defense sector. Then, all the way on the other side of the country in California, we have Stadco. Now, Stadco supplies mission-critical components for military aircraft and space programs. They use some highly specialized technology, like a massive electron beam welding cell. That's incredibly rare, by the way, and totally essential for the aerospace defense industry. But when we compare their financial performance, a glaring imbalance really reveals itself. You see, their revenue is nearly identical. Ronor brought in $16.9 million, and Stadco brought in $15.3 million. But look at the gross profit. Ronor is doing the heavy lifting here, pulling in a fantastic $6.3 million in profit. Meanwhile, Stadco is operating at a gross loss of $1.3 million. Essentially, Stadco was bringing in revenue, sure, but they were actually losing money on the work itself. Which brings us right to section 4, the strategic project mix. Just listen to how CEO Alexander Shen explains this turnaround. He stated they implemented a strategic project mix change at Stadco, resulting in reduced revenue with higher margin drop-through. Okay, so in plain English, they intentionally walked away from certain projects, they fired the bad clients, stopped chasing pure volume, and decided to only focus on work that actually yields a real profit. Talk about a game changer. And the result of firing those bad clients and shedding that unprofitable work, Statco completely eliminated over $1 million in manufacturing costs in just one single year. Seriously, it takes immense discipline to say no to a massive contract, but by doing so, Statco drastically reduced the friction and waste in their operations. They literally shrank their workload to save their bottom line.
Let's wrap up with Section 5, skyrocketing guidance for 2027.
So, despite shrinking their revenue in 2026 to fix their margins, customer confidence in TechPrecision is absolutely booming. As of March 31st, they're sitting on a massive funded backlog of $52.1 million. And beyond that, they have another $25 million in unfunded purchase orders just waiting in the wings. They basically have 1 to 3 years of high-quality work already lined up. Because the strategic fat has been trimmed and both Raynor and Statco are now primed for high-margin projects, their guidance for next year is just stunning. For FY 2027, they expect revenue to bounce back with double-digit growth, hitting up to $37 million. But more importantly, because of their newfound efficiency, they project an explosive 80% growth in EBITDA, aiming for up to $4 million. That right there is the absolute compounding power of high-margin flow-through. So as we wrap up this explainer, it really leaves us with one incredibly powerful thought to consider. In an industry utterly obsessed with top-line growth, could strategically shrinking your business, could literally walking away from bad revenue actually be the ultimate secret weapon for struggling manufacturers everywhere? TechPrecision proved that sometimes, you really do have to prune the tree to let it grow. Thank you so much for joining me for this explainer, and keep questioning the numbers.